Today, folks, we need to talk about TD stock as we do a brief analysis on the company. One of the most intriguing things by far is this absolutely insane yield. You got to go back all the way to the 90s, and never in the history of the second largest company in Canada, one of the 10 largest banks in the US, have we seen a yield at this level. I mean, according to this, we're at 5.78%. We take a look at the stock today, we're about 5.47. The thing is continuing to downtrend here. This yield is jaw-dropping, considering the company, the stock, year-to-date down 13%. Since the peak of 2022, we're down about 31%. This correction continues. And if we take a look at the dividend, also very impressive, from 47 cents 10 years ago, today about $1.02. If you look at the long history and you had the cojones, you've been around for 20 plus years, you were buying this in the early 2000s, your dividend went from 11 cents to $1.02. Holy crap, your return, your yield on cost would be absolutely bonkers. Let's just take a look at the dividend scorecard, because the 13-year growth rate, according to this, is about 7.57%. Very healthy. It's a very nice rate of growth. You know, you're doubling your dividend basically every 10 years. Certainly no complaints, right? So what I want to do right now is just take a look at some of the fundamentals, what's kind of been pressuring the stock. We'll read some articles. We'll actually take a look at some numbers. And if that is a conversation you'd appreciate, hit that like button, because the question is, should you load up on TD stock now? I mean, that's a question a lot of people are asking, and I'm just going to abbreviate to the bottom half of this article where it gets just a little bit more interesting. Higher interest rates are normally positive for banks as they enable financial institutions to generate better net interest margins. The steep increase in rates over such a short period of time, however, is putting pressure on businesses and households with too much debt. This is evidence in TD's provisions for credit losses, which we'll take a look at. The bank set aside $1 billion in fiscal second quarter Q2 of 2024 to cover potential loan losses, and that's up from $600 million the same time last year. As interest rates decline, the quarterly basically PCL, these provision for credit loss charges, should level off and eventually start to decline, as long as there isn't a deep recession that drives up unemployment. Now, this is the critical bull thesis behind the banks right now that I keep iterating to you guys, and why they're probably potential buying opportunities. But TD's problem with U.S. regulators have garnered a lot of media attention in recent weeks. The bank announced that it has basically set aside an initial amount of $450 million US to cover potential fines related to ongoing investigations in TD systems for detecting, basically stopping money laundering in the American operations, which we knew was a huge deal when that money laundering operation through drugs kind of came into play. But TD has a significant presence in the United States, with branches running from Maine right down to east coast of Florida. We know this, so the situation is serious to some extent. I don't think it's as serious as maybe the media is making it out to be, but pundits speculate the total amount of fines could reach up to $4 billion before the process is complete. Penalties at the high end of these estimates would wipe out a good chunk of TD's excess cash, which again is a huge concern, but I don't think this is particularly TD's fault. You have to imagine TD has been following the regulatory environment, and they, I think there's some bribing going on. There's a lot of issues, but I don't know if that is specifically, you can tie it to TD, right? So TD remains a very profitable stock, and we're talking about the upside, and its capital position should be adequate to ride through the turbulence as long as the penalties aren't too high. The bank will eventually get the mess sorted out, and growth in the American market should continue over the long run. Declining interest rates in 2025 should ease pressures on the over-leveraged borrowers. This should lead to a falling PCL. And again, this is what I'm saying is a huge defining factor here. We'll get to it when we look at the books, but it could result in some PCL recovery once the rates stabilize to lower levels, because again, the provision for credit losses are just sitting in a bank, and they can actually pull them back onto their balance sheet. They're just sitting there as cash, as just as reserves. So let's talk about, should you buy TD, and we can do our own analysis on this. Now, again, TD is one of the most resilient banks. Let me zoom my head out of the way and zoom these numbers in so we get a clerical idea of what's going on here. Because we're talking about a company over the 6 month, based on this last quarter, went from 24.5 billion, or almost 24.6, to 27.5. I mean, the company is considerably growing over a 6 month period still. Annually, I mean, from 12.3 billion to 13.8. The company is doing exceptionally well. The provision for credit losses, as discussed, has been going up. They put about $2 billion away over a 6 month span. That's insane, up from 1.28 this time in 2023. So the company's likely going to be putting over $4 billion away for loan losses this year alone. And look at the total assets. And we're going to take a look at the loan loss provision numbers, because it'll really put into perspective the faulty or kind of gross impaired loans versus the total assets that sit at almost $2 trillion. I mean, these gross, like these numbers are bonkers when we actually take a look at the total assets under management. It's quite impressive, especially when you start taking a look at total deposits and all this stuff. But what's really impressive here as well is the dividend payout ratio. You take a look at the adjusted, you're just below 50%. Earnings per share still very strong. Again, not growing because again, when you take a look at those loan losses and the provisions here, they're pretty high at 1 billion. So it's no surprise that if you take a look at that earnings at $2.04, it is, however, up from last year, but on a 6-month trailing, $4.04 versus $4.14. Again, we're not seeing a whole lot of growth, but there is potential for growth when they can stop dealing with this rocky market environment. So before we talk about the rocky market environment, right now the things that are really propelling the business, as far as I can tell, seem to be a lot of wealth management. They really have been kind of touting that, wealth management, which if you take a look right here, is actually growing pretty nicely, including TD direct investing. The average trades per day have been going up. Very nice. Average credit card spend has shot up a little bit if you take a look at the bottom left box here. Coming into Q1 of 2024, we're starting to get a bit of a recovery in credit card spending, but all in all, I mean, we can take a look there. The only thing really growing excessively is Canadian personal and commercial banking and global wealth assets. If we take a look at U.S. retail average volumes, not a whole lot going on here. But again, we've got forward focused. They're shaping the future with Google Cloud. They've got a lot of partnerships here that are quite impressive. And like every bank, they're probably going to start getting rid of brick and mortar. They're going to start focusing on digital banking. I know people that work at the banks, they said it's for old people. Most people don't go in the bank for much anymore. So we can see that, their mobile users have been growing almost at a double-digit pace for the most part. But again, if we take a look at the restructuring program here as well, before we take a look at kind of the provisions and gross impairments, I mean, they're going to be saving up to the full year 2024, expect saving of $400 million pre-tax. So like many businesses, they are refining and dining. For full restructuring program, the bank expects to fully realize annual cost savings of $725 million pre-tax. Which is beautiful, getting close to $1 billion. And this is something that I think is absolutely required in this market environment. And this is just that fine reminder of this refine and dine business, or businesses that have been, every company's been doing this. Every company's been laying off, doing what they have to do to make their businesses stronger in this tougher market environment. And I think it's going to get to this pivot where we're going to start falling over the other edge of growth. Because again, right now, if you take a look at gross impaired loans, we can see that they've actually started to level off quarter over quarter. This is like the first time we've seen a significant not decline, but a significant smaller bump up in gross impaired. Now, gross impaired doesn't mean these can't be recovered if they're real estate. Really depends on what these loans are, which we can see there's Canadian personal and commercial banking make up a fairly large chunk of this. Next in line is U.S. retail. So we're not talking about real estate being the huge defining problem here. But again, these are loans that are past due, which means if they can recover what they can recover, great. But again, these are what they're putting loan loss provisions aside for. And it's a pretty significant amount, $3.89 billion. But again, when you take a look at the total assets TD has, sitting at that $1.9 trillion, we're talking about quite an insignificant amount at the scale of this bank. So very fascinating stuff here. I'm hoping that this is, as soon as we start seeing this go the other way, that could be a huge buying signal where the stock could severely start to see some recovery and kind of start pulling us out of this downtrend. And it's something that you probably want to pay attention to, especially if you're a dividend-oriented investor, because these yields do not tend to last very long, as we've seen with most of the banks. I still like Bank of Nova Scotia with its almost 7% yield. It's not doing too bad, but we've seen a nice recovery in Royal Bank. And personally, I think quality matters for getting capital growth here as well. So when these big, mega banks start to not collapse, but their stock price starts to go down the way it has, like I said, you pay attention, you can lock in some great yields and typically get higher than average returns from these Canadian markets. So I'll pass the question off to you. I'd love to know what you think about it in that comment section below.